flipping comes with a different set of risks than when it comes to investing. Because when it comes to flipping, the goal is to sell it as soon as possible. When it comes to investing, the goal is to buy and hold. Of course, you can sell an investment at some point if you find a good opportunity or a good reason to sell, but the goal is to buy and hold. Here, the goal is to buy and sell as fast as possible. What are those reasons? Well, there's 4 of them. Number 1 is the time invested in order to do the deal. Number 2 is taxes. Number 3 is the income cap. I'll explain what that means. And number 4 is the risk that's involved. Starting with the time. If I wanted to go out and invest in a rental property now, I'd go out to find the property, do the research to find the property. After I purchase the property and do the renovations, I hand over the keys to a property manager who then does all the work. I don't know who the tenant is. The tenant doesn't know who I am. When the toilet breaks, they call the property manager, not me. I get a monthly report and a quarterly report and an annual report showing what's happening with the property, how much money we made, what the expenses are, and I just oversee what the management company does. So once the property is acquired, it's pretty passive on my end. I mean, yeah, I spend a little bit of time every month just reviewing the reports, but I'm not doing any active work. If I was flipping a property, there's a lot of time involved because now I buy the property and now immediately got to get the architects involved, got to get the contracts involved to do the renovations. Now, I'd renovate a lot of properties when I do a rental as well, but now when it comes to a flip, time is really important because every day that you're sitting on the property, you are losing money. Now, it's the same thing with rentals, but now you also got to sell the property as soon as possible. So you're constantly working to make the best upgrades, to get the property up and running, to flip it as fast as possible. So you're much more actively involved as a flipper versus as a real estate investor. You're more passively involved, which also then ties into number 2, your taxes. As an attorney who's not your attorney, what I can tell you is that our tax code charges you differently when you make money actively versus passively, especially in the real estate space. So if you go out and you flip a property, you make $100,000, you're going to be taxed at ordinary income tax rates. It'd be the same taxes you pay if you made the $100,000 from a job. But if you earn that money as a real estate investor because you're getting the rental income, you're taxed a little bit differently. You qualify for different tax deductions. You also qualify for different tax write-offs. This is one of the reasons why real estate investors love investing in real estate is because of these tax deductions. Because as a real estate investor, when I go out and I buy a property, I get a lot of deductions. For example, I get a deduction which says my property is 1 year older, so I deserve a write-off. You don't get that when you go out and try to flip a property. This is called depreciation deduction. You get to write off the value of the property even if the home price is going up. I still get to take that deduction, which means I can make money every single year and pay little to no money in taxes legally because the tax law says so. If you're flipping the properties, well, you got to pay taxes because that's the way that it works over there. Number 3 is the income cap. I can make a lot of money today if I go out and I flip a property. But once that deal is done, it's no longer in my hands. If I buy a property for $200,000 and I flip it for $350,000, I might be able to make a big chunk of profit today. But if in 5 years that property goes up to $1 million, I don't get to get any of those gains because I've sold. When I buy a rental property, well, that property might grow in value and I get to realize that if I wanted to sell it in the future, or I can pull cash out with debt if I wanted to, or you also get to see rental prices rise. So as the value of my real estate goes up, my rental rates generally go up as well, which means I get to make more money and I get to choose when I want to sell because I'm not under that pressure to sell when I flip. Because when you flip, you got to sell and it's a one-time transaction. You do something, you flip it, you get the money and then you walk away. Here, I make money every single month. And if the property values goes up, there's a lot of ways for me to take that money out or just keep it there, because you're not capped on the income. And 4th also is risk. I started investing in real estate back in 2011 after the 2008 crash. And obviously that was a horrible time for flippers because what a lot of flippers were doing was when home prices were going up very quickly between 2000 and 2007, 2008, people were taking on a lot of debt, doing a lot of flips and trying to just hold properties and flip them for quick profits. But then when things started to turn south, you lost all those opportunities because the home prices started to fall. And so you really are at risk of the economy, you're at risk of home prices, you're at risk of interest rates. There's a lot of things that can impact now your flipping game because you're constantly hoping the home prices are going to keep going up and that you can keep selling properties for a big profit. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs ebooks, my free financial newsletter by clicking that button below. Thank you for watching, and I'll see you in the next one.